Well, this week we're reviewing the 361 Met Target Return Fund. It's managed by Cy Jacobs. Now, the formation date is September 2005. The fund size 77.9 million rand. Benchmark is the repo rate, of course, and TER sitting at 3.12%. I mean, what is this fund doing to be able to charge such high costs?
Well, I think the first thing to take into consideration here is that a large portion of the total expense ratio in this situation actually comes from a performance-based fee. So it's not a flat fee that we're looking at. We're looking at it from a performance-based perspective. I mean, I fully agree. I think the fee is obviously on the high side here. I don't know what Roland, what do you think about the fees?
Well, again, the fees are benchmarked according to the repo rate. So we're actually saying if we outperform repo, we deserve a performance-based fee. If you look at the structure of the fund with about 75% in equities and 25% in cash, sort of on average, that should be the benchmark because that's what they're on average holding, rather than a repo rate.
This benchmark question keeps coming into the whole debate, you know.
Correct.
Yeah.
Well, as a matter of fact, let's just briefly look at returns quickly. 1 year, 23.6% relative to the repo rate of 5.5. 3 years annualized, 27.2 versus 6. 5 years annualized, 11.7 versus 7.9. So I mean, those are fantastic returns relative to that benchmark. But the question again is around fairness. How fair is this repo rate kind of benchmark? Just have a look quickly. This is the graph that we always put on. This is the Met Target Return Fund, and what I've done over here, it's not its benchmark, but what I'm showing you over here is I'm showing you the fund's relative return, and here the relative is the all-share index. And you can see the all-share index over time there. You can see how it decreases in value over there, shoots up in value, and those are rolling 12-month returns. The blue bars or the blue shaded areas obviously indicate the returns relative to that all-share index. And you can see some outperformance, as is evident over there. And if you look at those spaces over there, and then there are certain spaces where there's not much outperformance, you know, relative to the all-share index. So a mix as far as the total return is concerned here. Roland.
Yeah, I think we also need to look at what they're doing in terms of the allocation inside the fund. So if we're looking at the equity allocation or breakdown, again, it's quite aggressive in the sense that we can't see the shares necessarily, only the top 10 holdings. But there is some kind of defensive nature here with BAT. You got some insurers there, MTN, high sort of cash flow, defensive kind of stock with a strong dividend yield. Life Healthcare, that's been a good performer. So it's pretty hard to discern what kind of fund style this is. Is it value?
Yeah, that's what I was going to ask. You know, why are they choosing these specific stocks? What are your thoughts on this fund? You know the fund. You mentioned it's expensive, but what are your thoughts?
Well, I'm just stunned by the fact that there's a performance fee and you benchmark an equity fund against the repo rates. I mean, so inevitable there will always be performance fees.
I mean, that's what equities are meant to be doing.
Yeah, and I mean, if you benchmark against the alls here, as Cobie showed you in that graph, that's a different story than to charge a performance fee. But to charge a performance fee on a cash rate or a repo rate, I mean, it's just ridiculous to say the least.
So you wouldn't recommend this?
Not at all.
Not at all. Okay, well, where are we going to go with this conversation then?
Well, I mean, you know, the thing that I think also to take into consideration here is that if you look at a business like 361, I mean, they grew up in the hedge fund space. So they've got a strong inkling towards kind of hedge fund techniques and understanding hedge fund management techniques. And I mean, if you go back in time, this is often what hedge fund managers would do. They would say, look, it's absolute. So there's a cash rate attached to what we're trying to do, but we're trying to keep this fund in an absolute space. This obviously is not a hedge fund at the end of the day. This is now a long-only fund. And it's one of two that 361 actually manages at the end of the day. So hefty total expense ratio at the end of the day. You're looking at an equity fund, and the question is, what is it you're trying to achieve, and what are the alternatives as far as other equity funds are concerned in the space?
Yeah, and I mean, given the fact that it's got such a high expense ratio and it's not using the right benchmark, one would assume there are better alternatives.
Well, the best way to probably judge this fund is, it's not the best way, but a better way is to compare them to similar equity funds. So at least you've got a peer group kind of comparison, because the repo rate really isn't relevant here. So if we haven't obviously got that, but it would be interesting to see how this fund would compare to other funds with 75% on average in equity or the general equity fund.
A 3-year annualized return, 27%. That's good. That's good.
That's right. Our market has probably doubled over over the last couple of years. So you can see where those returns are coming.
Yeah. In terms of the key standouts with regards to sectors and everything, anything we need to note on that end?
Yeah,
obviously it changes all the time.
As I say, we can only see the top 10 holdings of this company, but I would probably say that there is a conservative bias, a defensive bias, in other words, a high dividend yield kind of strategy in place. So again, you've got 25% in cash and you are conservative on the equity side. You'd probably want to see more aggressive on the equity side, and given that you've got so much money in cash.
Okay, Jan-Carel, while we've got you here, tell us about some of the funds that you really do like at the moment, the type of funds that you are recommending to those that are long-term investors, do have a bit of time on their side.
Well, we like funds that ultimately try and achieve a return in line with inflation, in other words, real returns, because we believe that's the best way to slot in a fund into a financial plan, because ultimately people's money needs to last for their retirement life, and CPI is everyone's worst enemy. So we like funds that's really aggressively targeting, whatever the circumstance might be, targeting to outperform inflation by a certain amount.
Yeah. In terms of equity percentage, offshore allocation, you taking a look at that at this?
Well, what we try not to do is to try and second guess. We leave that for the fund managers to try and look at that allocation.
That's their job, not your job.
That's their job, most definitely.
You see, I think the other thing, and just important again, is objectives. What is it that you're trying to achieve, and how will you achieve that? If you've done a personalized asset liability model, hence you've understood what are your assets and what your liabilities are that you potentially need to match over time. How is it that your assets need to work in order to help you actually gain that? And then as a secondary alternative, you need to start understanding risk and how risk potentially fits into that category, rather than always starting at front with risk and saying, well, how risky do you want to be? That really has nothing to do with investing at the end of the day. It's something, it's a secondary consideration. And once you understand the objectives, you understand kind of how you could kind of slot in. And then by all means, you could look at a fund like this, and you could look at any other fund if you're going to be looking at equities. And you're looking for payoffs, cost versus benefit, and what do those two look like long term?
Do you like this fund, Cobie?
I think it's a bit expensive.
Yeah.
I think it's slightly expensive.